Hello everyone, my name is Zach and welcome to On Cash Flow, where I help you become a master of your own cash flow. Now let's get started. Overall, I'd say that financial independence and early retirement is a good thing. But like with most things that are great, it comes with a lot of myths. Alright, and that's what we're going to be talking about today. We have 5 myths that we are going to be going over today about financial independence that you might still believe. All right, let's go ahead and dispel those. The very first one that I want to talk about today is right here at the top. FIRE is easier with a high income. Okay, I think actually the opposite is mostly going to be true, at least when you're starting out initially. If you're already starting out with a high income, then you're probably at a disadvantage to someone who's starting at a lower income. Because what happens in, at least the United States, and probably around many of developed countries, is that when you have a high income, you fall into that high income upper middle class trap, where you start buying lots of liabilities, lots of things that are going to require you to spend your high income. And so what you'll find is a lot of people that start out with high income also start out with a high amount of debt. And that means that they have to work their way out of that debt and get back to zero first before they can start building their wealth. So someone in the upper middle class with a high income might have multiple cars, they might have boats, a really large house, all these kinds of expenses, all these kind of liabilities that cost extra money every single month. Whereas someone starting out with a lower income probably won't have as much debt like that. They might not have as much liabilities that are going to require all of their income. And so if they can get their income to be high without already having a lot of liabilities, without having a lot of debt, then I think it can be easier to achieve financial independence if you don't start out with a high income and start out with a high amount of debt. So let's go ahead and fill out number 1. Next up, myth number 2 that I want to discuss with you today is that the 4% rule is an accurate statement, like an accurate way that you're going to live your life in early retirement, especially if you're in the FIRE community, especially if you're going for financial independence, retire early. If you're going for that kind of retirement, I think that actually the 4% rule is not an accurate depiction of what your life is going to be. It's not going to be how you're going to spend your money in most circumstances. And that's because there are a lot of assumptions behind the 4% rule. And in my mind, I actually think of the 4% rule as an actual worst case scenario, because that's what it's actually meant to be. It's supposed to say, hey, your portfolio will survive the worst case scenario, at least what's happened so far in the past. Your portfolio will survive the Great Depression, the Great Recession, and all the other, crazy events that have happened, like hyperinflation and all these kinds of different things. So the 4% rule is actually a worst case scenario. And it has lots of other assumptions around it as well, like you're going to adjust your spending for inflation. And as we've seen, at least in recent times, as I'm recording this video, we've had a higher than normal inflation, a much higher than normal inflation, and you might not actually be affected as much by some other people, especially if you are in retirement, especially if you are, financially independent. And that's because the CPI tracks the average worker in an urban area. That's usually the most common and the most quoted CPI index. So the CPI tracks like pretty much the average American spending, who's the average American worker. And the way that they're affected by inflation is going to be different than you might be affected by inflation as someone who is financially independent or someone who is retired. So me personally, in 2022, I actually haven't seen that much of an effect on my spending when it comes to inflation. Now, of course, I definitely have noticed inflation. I've definitely noticed some of my spending categories going up, but I haven't noticed it as bad as what the posted numbers are. And that's because I don't actually spend that much money to begin with. And it's also because I don't spend my money like a normal average American does. And you might not either if you're looking to retire early. You might be a little bit more frugal. You might not be affected by inflation as much. So your personal inflation rate might not be equal to the posted CPI rate. And therefore, you might not actually need to increase your spending every single year at the exact same rate as the CPI. Another assumption of the 4% rule is that you will never earn another penny again. So you're only relying on your portfolio income. And that is probably simply not going to be true. It's probably not going to be true that you're going to go for the next 30, 40, 50, 60 years without ever earning another penny. There is most likely going to be some kind of earning within those years. And if you think that you're not going to earn any more money ever again, then I would challenge you and say that you're probably wrong. You're probably probably going to pursue something that is going to earn you some amount of income. And even a small amount of income, even a small amount of replacement for your portfolio withdrawals is going to drastically increase your chances of success. It's going to drastically increase your chances of even gaining more wealth while you are retired, even while you're living partially off of your portfolio. All of those reasons and many, many more, I think that the 4% rule is actually a worst case scenario, and it's actually not an accurate way that you're going to be living your life in retirement. So let's write that up on the board. And really quick, again, speaking with number 2, when it comes to the 4% rule, that's a big reason why I think that personally, a kind of barista FIRE type of financial independence is probably going to be right for most people. Beyond the actual like normal financial independence where you're actually trying to follow the 4% rule where you never earn any income again. But we'll talk more about that later. Let's go ahead and move on to point number 3, okay? So point number 3 is you need to be blank for FIRE. You need to be debt-free for financial independence or debt-free for retirement. Okay, this is simply not true. And while this might be a goal of many of us, including myself, I didn't want to be in any debt when I said, okay, I'm financially independent and I'm going to go and quit my W-2 job and try to pursue filming myself on camera. This is not actually technically a requirement to be financially independent. Yes, having lower expenses, but therefore not having to service any kind of debt payments is going to make financial independence easier, and with a less of a net worth, you need less withdrawals, you need less spending if you have no debt, but it is not an absolute requirement. You absolutely can achieve financial independence. You absolutely can be retired, and you can stay retired even if you do carry some debt with you. All right. Now, obviously, it's going to be better if you're carrying out low interest debt. You don't want to be carrying, credit card debt at 20% interest. But if you have auto loans at, let's say, 2.3%, and sometimes you can even see them be at like 0%, as long as you bake those payments, bake? What is this, a cooking show? As long as you put those payments into your spending, like into your spending plan, there is no problem with actually carrying debt with you. The same can be said with like a mortgage. Now, I personally did pay cash for the house that I'm in right now, so that I didn't have to have a mortgage payment while I was, in financial independence, okay, because I thought that was a good defensive move for me to make. You absolutely do not have to have a paid off house in order to become financially independent. You do not need to be debt free. You just need to make sure that the amount of expenses that you have are already calculated into your spending budget and therefore calculated into your FIRE number. So let's go ahead and write that up on the board. I think that number 3 on there is probably one of the most prevailing myths, that you do have to be debt-free. But one myth that also you might have heard of that is absolutely not true is that you have to be financially independent to like this video. Okay, so anyone can like this video, and if you're enjoying this video so far, please make sure you like the video. It really does help me out, and I would really appreciate that. All right, now let's get on to number 4. Myth number 4 that I have for you right here is a pretty good one, because this is very, widespread within the FIRE community, and that is you must be frugal to achieve financial independence and to retire early. This is an absolute myth. You do not have to be frugal at all. Here's the quick summary on how you can make that happen. If you just automate your investing and you spend everything that's in your checking account, you still will achieve financial independence without any kind of budget, without any kind of monitoring of your spending. All right, you might not be spending on the right categories that you ultimately want to spend on until you understand your spending, but you still can achieve financial independence that way. For example, if you're making approximately $50,000 per year and you just max out your 401k each year, a little over $20,000, that is a pretty high savings rate right there. And if you just spent everything else that went into your checking account from your paycheck, you still will achieve financial independence in a relatively short amount of time, because the action that's actually required to get to financial independence is actually investing. And if you have that on autopilot and you don't worry about your spending otherwise, you don't worry about being frugal otherwise, then you're still going to get there. So it is a myth that you have to be frugal to achieve financial independence. Now, the lower that your income is, probably the more frugal you're going to have to be. The higher your income is, the less frugal you're just going to have to be. That's just how it works. That's how math works. But to say that everyone needs to be frugal, like everyone needs to spend the same amount per year, like for me, I actually am frugal, but I don't think that you actually need to be that frugal. So for me, I spend about $25,000 per year right now. That is my FIRE budget currently. You don't need to be spending that amount of money. You can spend double that. You can spend triple that and still achieve financial independence. As long as you're investing a relatively large amount of your income and you're investing it smartly, such as into passive index funds, then you will achieve financial independence without really any thought of being, super frugal. But we do have one more here, and that is myth number 5. But before I move on to myth number 5, I want to know from you in the comments below. What are some other myths out there about financial independence? What have you heard? What have you believed in the past? Please share them with me in the comments below, and let's discuss some more financial independence myths. But the last one that I have for you today as number 5, and number 5 is FIRE is the key to happiness. Financial independence will not bring you happiness. Financial independence on its own, having a high net worth, having the ability to not have to work for a living is not going to bring you happiness, all right? Ask most people what's going to bring them happiness. Money is not going to be the answer to that, all right? Most of the time, it's going to be your family, your friends, your relationships. A lot of things that are a lot more simple and don't require money at all. And that is pretty universal around the world when it comes to happiness. Things like friends, family, and community and such are probably going to be the things that are going to lead you to the most fulfillment and the most happiness, a sense of being. So these are things that are well beyond the finances, well beyond investing, well beyond net worth. Financial independence, it is a tool that can allow you to pursue a happier life, but it on its own is definitely not going to lead to happiness. So if you're on the path to financial independence and you think that once you achieve it, once you're able to quit your job, once you no longer have to work for a paycheck, if you think that that's going to lead you to happiness automatically, then you are in for an unfortunate surprise. And that unfortunate surprise is going to be that you're not going to be any happier. You might even be less happy if you think that is true. So please don't think that financial independence is going to bring you happiness. You're going to have to find that in other ways. But you can use financial independence as a tool to help bring more fulfillment and more happiness within your life. So let's go ahead and write that up on the board. Is happiness spelled with 1 P or 2 Ps? I couldn't remember. Making a fool of myself right here. I did graduate college, okay? But there you have it, 5 myths of financial independence that you might have believed before. But don't go just yet, because as I mentioned before, I think that financial independence in a more barista FIRE type is probably going to be the best path for most of us to take. Okay, that's the path that I took. That's the path that I think that most of us should be taking. If you want to learn more about why barista FIRE is probably the best form of financial independence for you, then definitely check out this video that's going to pop up right next to me. Thank you so much for watching this video. My name is Zach from OnCashflow.com, and I hope to see you next time.